Hello and welcome to The Resilient Investor with me, David Stevenson. In each of these episodes, we try and walk our way through the investment challenges facing a reasonably early stage beginner investor who's sort of trying to work out how to manage the risks and opportunities, and the risks of investing in everything from, anything you can really stick into an ISA or a SIP or an investment fund. And what we try and do is touch on the kind of big themes that people try and work a portfolio into. Should I invest internationally? What about the UK? What kind of product structures can you find? What fund structures are out there? What are alternatives? All these kind of questions come into any kind of investor's journey as they try and work out how to build a resilient and diversified portfolio of, individual stocks, funds, whatever it is you want to invest in. In one of our previous episodes, we talked to Ross Driver from Foresight, who invests primarily in the kind of solar market. That's kind of solar panels, large numbers of them in big fields, and then you generate an income off them. And what that raised is the issue of alternative investments. And we talked a bit about that with Ross. And alternative investments have really, really become much more important in the last 10 years. When I first started writing, probably in the beginning or the middle of the noughties for people like the FT, I can remember writing one of my first columns in 2008 about what was then one of the first infrastructure funds listed on the stock market. It's now called HICL. It's been going for quite a long time. And in those days, there were barely any infrastructure funds listed on the London Stock Exchange. Now there are dozens of them. And it's moved beyond that because people like HICL were always just investing in classic kind of infrastructure, things like, schools or hospitals or roads, that kind of stuff. Now there's all sorts of infrastructure investments out there, and they really appeal to lots of investors, income investors, because they pay a nice, generous income quite often, very good income at the moment. They appeal to people who are worried about risk because they are less risky than some shares are. It's worth pointing out they're not no risk because there are risks involved. They appeal to lots of investors because they're quite often less volatile in their share and their share prices. So they appeal to lots of investors, but they can be quite a tricky area to get your head around. But the good news is there's lots of investment trust analysts, because most of them are in investment trusts or closed-end funds, roughly the same thing. There are a lot of good investment trust analysts out there. And we've got one with us today, Elliott Hardy, who's investment trusts research analyst from Winterflood. Elliott, welcome.
Thanks for having me. Nice to be here.
Now, we're going to talk a bit about alternatives, probably a little bit of a skew towards renewables. Let's first of all put a definition. Why, if you're a kind of early stage or beginner investor, you've been taught there's things called equities, stocks, shares. There are things called bonds. There could be gilts, corporate bonds. Why would you look at alternatives? Where do alternatives sort of fit in this? They are equities because they are shares, but they've got income-like, many of them. They've got income-like characteristics. So they're a bit like bonds. What's alternative about them, or what are the different bits of this sector?
Sure. So at the moment, there's over 30 infrastructure funds at the moment.
Mm-hmm. And they're mainly infrastructure.
So this is across infrastructure, yes. There's also private equity, real estate, et cetera.
Yeah, so there's quite a lot of big segments within alternative funds, aren't there? So
yeah.
Exactly. And when we mean alternative, quite often we're talking about they don't invest in traditional equities. So I set up a fund, David Stevenson, US or UK equities, and I buy shares in US and UK equities. They don't tend to invest in equities, do they?
No, exactly right. So I guess within an investment trust structure, one way of looking at it is that it's a listed equity wrapper, but it invests in sort of the underlying investments are quite illiquid in nature within the alternatives.
What do we mean by liquid? It's
so difficult to buy and sell, or in this case, they're not sort of traded on the stock market.
Yeah.
And that's quite interesting for retail investors in particular, because it means they get access to a range of different assets that they perhaps wouldn't have otherwise access to, managed by a specialist asset manager who is perhaps an expert in the field and who knows quite a lot about how to run the assets. Bear in mind, they're quite technical in some cases. Overlaying that, we have an independent board, which is there to sort of protect investor shareholder interests. And because of that, we've got quite an interesting structure to access these investments, and one that is quite liquid in nature, so you can buy and sell these shares on the stock market quite easily.
So that's an interesting trade-off there. So you're investing in underlying things, assets, businesses, or projects, maybe even, which are a little bit illiquid. It's not fair to say they're completely illiquid because there are lots of people trade them, don't they? They just trade back and forth between different companies. You can sell them. If you've got a wind farm, you can probably find a buyer for a wind farm, I imagine. But they're not liquid, as you said. They don't. You can't ring up a broker or go online and say, "I'd like to sell my wind farm." Well, maybe you can. I don't know. But they're not liquid. But it's in a liquid structure, so you can transact pretty much all of these funds on an online platform and buy them as you would, I don't know, shares in Nvidia or BP or anything like that. So it's that trade-off between illiquidity of the underlying assets and the liquidity of the shares that you're buying.
Exactly. From the investor's perspective, you've also got another angle, which is from the manager's perspective, in the sense that these offer an evergreen capital structure.
What do we mean by evergreen?
So we mean that typically, perhaps in an open-ended fund, a manager, if they had redemptions by investors, so if an investor in their fund says, "I want my money back," that means they have to distribute that capital right away back to their investors.
And that's relevant. So a good example, which has hit the news over the last couple of years, is lots of people invested in mutual funds or unit trusts invest in property.
Exactly.
And they bought into a fund that's bought a bunch of offices, for argument's sake. And for love of money, they can't sell the offices, because the office price is going down. The investors go, "Hang on, I want to get my money out." And the manager of the fund goes, whoa, stop there. Hold your horses. You've got to stop because we can't just sell an office like that. You want being facetious here, you want your £250,000 back. We can't just sell an office like that. You're just going to have to wait.
Exactly. And wait and then potentially gate as well. So you might then not be able to redeem your assets and you might be stuck in that fund.
Yeah. So that's the great advantage of this interesting trade-off between having liquidity in shares in real time and be able to sell them in real time and then having illiquid assets. Then there must be a downside to this, though. There must be a flaw. Every cunning plan has a flaw. What's the cunning flaw here? And I imagine the word discount might come up.
Yeah, discount might come up. I think share price volatility, of course, is the one downside. Ultimately, investors must remember that these are listed equity wrappers, and therefore, whilst in some cases we're investing in long-term assets, so quite a lot of the characteristics we like about these assets, in the sense that you're 20 to 30-year government-backed contract, perhaps.
So that was when we're talking with Ross. He had solar farms that had long-term contracts that
exactly
lasted like 10, 50, 20 years.
So these are there for 20, 30 years, let's say. But at the same time, you've got a share price which is quite reactive to short-term movements. So perhaps changes in interest rates, sentiment around valuations, etc.
Power prices.
Power prices, exactly.
Yeah. Okay, so there's that. So there's the volatility of the shares.
Yep.
Now that presumably means that I bought for argument's sake, 5 wind farms, 5 solar farms, got them in my nice fund. I've set my David Stevenson Alternatives fund up. I'm generating an income. Presumably that's why we do it, really, isn't it? Because, I suppose you could hope. I mean, you could hope that there could be some capital uplift, i.e., wind farms and solar farms become more valuable, I suppose. So there could be some capital uplift, but you're mainly doing it for income, aren't you?
Yeah, I mean, all funds have a stated total return target.
Yep.
And the blend between income and capital growth within that target differs fund by fund, sector to sector.
Yeah.
So let's take infrastructure as an example. Funds like BBGI, Global Infrastructure, in the social infrastructure space that invests in sort of schools, etc., would perhaps have more of an income tilt because they're getting steady income over time.
Yep.
Whereas perhaps other funds in, say, economic infrastructure or digital infrastructure.
So we're up with data centers.
Exactly. So the kind of plumbing for the internet, let's say, data centers that require a lot of capital expenditure and therefore a sort of lean towards capital growth.
Yeah. So what would the ranges be? So most of the infrastructure sector, most of the alternative sector, but most of the old infrastructure sector yielding probably something in the 5 to 10% range, something there.
Yeah.
That sounds about right. And so now you mentioned a crucial thing, which will of course affect the share price, which is of interest rates. Mm-hmm. And a lot of investors sometimes go, well, how do interest rates affect share prices? I don't really understand that. But it's worth going over that mechanism, isn't it? Because let's be honest, you've got a couple of choices. When you've got money and you want to invest, you can hold it in cash, and hopefully never lose money on cash. Yeah, you might if inflation's high, but you'll get paid a cash interest rate, and that cash interest, well, if you're lucky, that is, you're not being stitched up by some of the brokers. But anyway, but you get a cash interest rate, which hopefully be near the interest rate. So, 5% at the moment, but maybe you get 4%. So you get 4% for taking absolutely no risk at all. Then, if you've, for instance, got a fund that's only paying 6%, 5%, you might go, is it worth doing that extra risk when I can get 4% just by investing in cash or government bonds, which hopefully will always get paid back? So is that the dynamic which influences the share price and interest rates?
Yeah, I think that's fair to say. If you look at discount moves relative to yield moves or government bond yield moves, the two are actually quite sort of closely correlated together in the sense that as yields go up, the premium is obviously smaller and therefore discounts have widened. Yeah. Because the premium to invest in these funds, or investors just don't think that risk premium is warranted in some cases.
And what do people tend? And if investors are looking at things to watch out for, I sometimes talk about bond yields. So what would you look at? 2-year government bond yield, 10-year government bond yields, those kind of things?
I think 10 years typically the sort of conventional proxy, yeah.
Yeah, so I can't remember what they are at the moment, but as I think as we speak.
I think it's like 4.3%
yeah,
at the
I was
moment.
going to say somewhere around 4.3, 4.5, yeah. So basically, in simple terms, I can take no risk, get 4.3, or I could take some risk and I can get a number above that. And if you want to take some number above that, you probably want a much bigger number above that because your share price might go down. Yeah. Okay, so we've established a mechanism. Now, for a long time, a lot of these alternative funds in the infrastructure space were trading at a premium. The classic traditional ones, like you mentioned, BBGI, HICL, IMPP, have been around for decades, I think, certainly longer than 10 years. They were trading. They were trading at a premium. Yeah. Let's see. What do we mean by premium in investment trust terms?
Yeah. So a premium is where the share price is greater than the NAV per share.
So the total value of all the assets in the fund.
Exactly.
And they were trading at a premium for a long time, and quite often they were yielding, because it was interest rates were low, they were yielding, I can't remember that, 4.5, something like that. Now they aren't trading, well, not all, a few of them are, but most of them are trading at a discount. What are discounts like in the infrastructure space? Run me through it. And what does a discount mean?
Yeah, sure. So, I mean, if we talk about discount moves, let's take renewable energy infrastructure as an example. So, the weighted average discount in the sector is around 25% at the moment. And if you look at that versus the 5-year average, the 5-year average is a 3% premium.
Wow.
So that's quite a difference. Exactly. And the kind of dynamics that you were speaking to earlier with respect to government bond yields largely explain that. Yeah. Because ultimately the share price is a kind of indicator for where investors think the NAV should sit. Yeah. And therefore, as discounts have widened, as interest rates have gone up, there's been a general expectation that would drag on valuations, and therefore discounts have widened.
And what's the average yield for, say, that sector, the renewable? Is it roughly what I'm guessing? My top of my head, I'm guessing 6-7%.
Yeah, I think that's about accurate. Yeah,
something like that. So you're getting really 2.5% bump over risk free.
Exactly. Yeah,
and that has almost mathematically, in an odd sort of way, translated through to a discount.
Yep.
Okay. So, but it's not the only factor driving renewables, is it? Because there's power prices, there's other things, and also we can't forget that all funds have their own idiosyncratic features. So some of them are a little bit riskier than others. So I don't know. I mean, if you're much less risky if you've got government contracts, I assume. Going back to data centers, they don't tend to have government clients. Yeah, they tend to have private sector clients. Big ones, I might point out, by and large. So there's risks to do with what the fund does, aren't there?
Exactly. Yeah, it all comes down to sort of, I guess, horses for courses, which is quite apt today with the fact that 4 horses ran across London.
Yeah, as we're speaking, probably 4 horses ran across the 4 horsemen of the apocalypse.
Exactly.
They were captured.
But yeah, in terms of sort of classic risks that you tend to look at, you look at power price risk. Yeah. So some funds or some generators have a significant wholesale proportion of revenues.
And that's because they sell into the wholesale market.
Exactly, rather than having these kind of fixed type subsidy contracts. Yeah. So the likes of kind of UK Wind and Erie potentially being over 50% wholesale at the moment would serve as an example.
And that's more risk.
That is more risk. Yeah. I mean, there is upside, right? If power prices go back up. So we saw that in 2022. You wouldn't want as much fixed exposure then. But yeah. Then there's also development risk. So as we look at, and this links back, I guess, earlier to the conversation of total return. Yeah. So there was a kind of a point in time in which these funds started to look towards taking on development risk to offer more of a capital growth element as well as to subsidize that income return that they had.
And let's just explain the life cycle of an investment. So
yeah,
I want to invest in a wind farm or a solar farm. I find the land.
mm-hmm.
Yeah. So this is early stage.
Yep.
I then have to get all the permissions. I then have to build all the wind farm stroke solar panel farms.
Yep.
Then I have to get it connected. Yeah. And then I have to turn it on. And then even once I've energized it, I've got to find somebody to do a contract with.
Yeah, and I mean, a good example is if you Google offshore wind turbine getting delivered to the site, it gives you a sense of the scale of these things. Yeah. They're not small bits of machinery or bits of
the latest, metal. The world's biggest wind turbine now is apparently taller than the Shard.
Exactly, it's crazy.
I don't know how they get that thing up is entirely beyond me, but anyway. Okay, so development's got its own risks, clearly, because you could, and it's worth elucidating those risks. It's kind of like you've got to get physically. There's lots of engineering challenges, and there's actually connection problems. It's everybody thinks, oh yeah, put a wind farm up and I'll just connect it. It doesn't quite work that way, does it?
No, but also from a cost of capital perspective. Yeah. So the returns that you must get from these projects, the uplift through construction, that hurdle rate has got a lot higher as the cost of capital has got higher. And a great example of that last year was Vattenfall pulling a lot of offshore wind projects because simply they became uneconomical.
Yeah.
And that's a theme that we've seen play out throughout the renewable space that's been quite important.
Because I mean, I'm going to bring some acronyms in here. So a lot of private equity like investment has a thing called IRRs, which is kind of internal rate of return. And that's the kind of thing you get out the back of the factory of gate pricing of the risk. And if interest rates have gone up, say, to 5%, and your IRR is only, I don't know, for argument's sake, 10%, yeah. Then, if your risk-free rate is 5% and your IRR is only 9.5%, for argument's sake, gosh, you've only got a 4.5% margin, it might not be worth it. But if its IRR is 15%, it might be worth it because you're still making 10. But surprise, surprise, the IRRs at 15 are probably more likely to be riskier than the IRRs at 9.5. Is that roughly how it works?
Yeah, I think that's fair. We also look at it sort of from a weighted average cost of capital perspective, which we don't need to go into today, I guess. But what is quite interesting is how investors are looking at that versus sort of the buyback side of things and capital allocation.
Right. And we'll come to that. So you've got your big discount there.
Yeah.
And discounts, so we've already said discounts do change. They can be premiums, they can be discounts. Presumably they can be even wider than 25%. In fact, I know they can get wider than 25%. So it can get above 50%. So what can you do to get the discount down if you're a renewables power company or, I don't know, solar company? What can you do?
Well, the good thing is that investment trusts have independent boards in place whose job it is to protect shareholders' best interests. And they've been quite active, actually. So they've been buying back in record amounts this year relative to last year, relative to history even. There's also been talks of mergers, acquisitions within the renewable space. There's also the potential for a private investor or house to come in and take one of these funds if they think that it looks attractive from that angle.
Well, that has already happened in social housing, so Civitas.
Yes, so we've seen a lot of it in property, but in infrastructure we haven't seen that as much yet. And
so let's walk through each of those steps in turn then. So I do a buyback. Why is buyback accretive? Because you hear this term, it's accretive to your NAV. Why does that? Because presumably you do a buyback, what happens if the share price goes worse? Then it's not accretive, is it?
Quite simply, if you think about it with respect to NAV and share price. So if you've got a pound's worth of assets, we're in a situation right now where if a fund is trading at a 30% discount, you can buy those for 70p. And that is quite attractive if you believe that net asset value is a true representation of
that's the point, isn't it?
The valuation. Exactly.
Way to put it in hard numbers. Let's use my example. Let's say your IRR is 10% and your share price is £1, and your share price is 70p, and your net asset value is £1, and every pound you're making 10p return, 10% IRR, and 10p return, and the share price is 70. You buy the shares back, then your return on that purchase is 10p over 70, so which is above 10% yield. In fact, IRR is probably much higher. So that's how it works. Okay, and do all sharebacks work?
The jury's still out.
Yeah.
I think the thing that's important is that it's a signal to investors. So it is a signal of or commitment to that valuation.
Yeah.
And in cases where perhaps asset recycling isn't happening, or where they can't sell assets to prove their NAV, buybacks are a good alternative to show that they believe in their NAV and they think that it's accretive to buy back.
And that recycling point is simply that you could just have a wind farm or a solar farm and you could just sell it and it say, well, it cost me 10 million, it's in the books 10 million, and we sold it for 10 million.
Exactly.
So it's worth what it says it is.
Or in some cases above the valuation, which is another topic altogether.
But. Okay. So where do those valuations, let's just talk about valuation for a minute again, because it sort of brings us all back to valuation, because we've mentioned a lot about net asset value, haven't we? Where do valuations come from? That I've always intrigued by that. I mean, I think I know the answer, but how do people come up with that? I don't know. Our wind and solar farms worth £1. How do they do that? Because presumably, do you do that based on the fact that it's generating an income, and then I work it back from the income, and interest rates are X, and this is what my income is, and then I'm going to estimate it's worth this, or do you then compare it with prices for other wind farms? How does that valuation model work? I think because if you don't believe in it, that's a problem, isn't it?
So, I mean, this is a big part of my job, right? So There's a lot of assumptions that go into net asset valuations. So from a fundamental sort of basic perspective, you've got a discounted cash flow whereby, yes, you look at the profits or revenue that you expect to generate from an asset over time. You compare that to what you expect to happen to power prices. And in terms of if you've got your generation, you can work out the revenues and discount that back to today. There's also assumptions that overlay on top of that. So sensitivities to inflation. So if you link to inflation, you might see revenue uplifts over time. There's also assumptions about asset life and degradation of assets, things like battery storage, whereby if you run the asset harder, they might degrade the asset faster, etc. And I guess the point is investors have to take a view on either side of these assumptions throughout. And that is the great challenge, and why we've seen discounts widen, because there's been uncertainty more generally about where these valuations sit.
Okay, so we've talked a lot about the models, the risks and everything. Let's just finish off by talking about opportunities. So what are the opportunities, do you think, in this space at the moment? So the discounts are quite high. We've already said, so let's just go our checklist. Discounts are quite high. So presumably there's opportunities there. There might be opportunities in takeovers, maybe. Where are the opportunities at the moment?
I think discounts is one point, and discounts are historically wide. I think more generally, if you zoom out and look at it from a long-run perspective, because you must keep in mind that these are long-run assets, and so should be viewed through that lens.
And with long-run, you mean what, 10, 20 years?
10, 20, even longer in some cases, So if we look at government, if we look at the energy transition as a sort of structural demand driver, for instance, within renewables, government plans to take offshore wind from 14 gigawatts about today to 50 gigawatts by 2030.
Wow. Threefold increase.
And we've spoken in this podcast about the cost of capital and how that's become uneconomical in some instances. And my view is that the government will probably have to step back in and make that economical in the future. And ultimately, the demand isn't going to go away. We need to transition to net zero. We need to hit these targets. And therefore, I think that represents quite an interesting angle. Also, on the digitalization front, AI was probably the topic du jour of 2023 and continues to be today.
Exactly.
And, the plumbing of the internet, the data centers, the build out there is also an interesting proposition. And then finally, I guess you shouldn't also lose sight of what the investment trust structure offers. So I used to advise DB pension schemes who would have to meet a certain minimum investment to pay into an LP fund that looks at these kind of asset classes. Whereas today an investor can invest in a diversified portfolio from day one that's traded liquidly on the stock market. And that, I think, in itself is an interesting proposition. And
I think I'd add on that, I'd agree with a lot of that, is that we've got great choice in the UK market. Actually, you've got real good choice, and you can actually look at all the data virtually real time on each of these funds, because they all have if you go to the website of a fund, that will usually have an investor page, and then look at the investor page, you can usually see a little tab that says RNS or news, and you could literally read every statement they've made, and you don't really get that with other investment structures, that degree of transparency. And they have to quite regularly report on how they build their NAV, what the power prices are doing, what government price, and I think that level of disclosure is really valuable. So, and with a lot of other things, you just have to take it on for granted that you're getting this information, but you get that with investment trusts. So if you had to identify one particular area at the moment we'll finish on, I'm not going to ask you to name a fund, but what one particular area do you think is the biggest opportunity at the moment? I think put you on the spot here.
Yeah.
Come on, you've got to come up with something. Just to generate. What do you think? Do you think it's digital? Do you think it's battery storage? Do you think it's renewable power? Do you think it's what do you think is a particularly interesting area at the moment?
Yeah, I think battery storage is a really interesting area, particularly with where discounts are currently.
Pretty big.
I think there's been a readjustment in investor expectations in that sector.
Yeah.
And I think there will be a process of kind of consolidation or, realignment of those expectations. However, if we are to build out all this renewable energy that we need to facilitate the transition to net zero, we need an almost similar investment in grid infrastructure and providing the kind of support for that volatility of generation on the grid.
Because it's not always windy, it doesn't always shine.
Exactly. And therein lies the opportunity with battery storage, which I think is an interesting one. And at current discounts, you're not just getting that value NAV perspective, but you're also getting a share price that is at a significant discount to net asset value.
Lovely. Okay, Elliott Hardy from Winterflood, thank you very much for a fascinating discussion. Join us on the next episode of Resilient Investor, where we'll look at other topics to do with the world of investments. And that's it for now. Enjoy investing. Bye-bye.